The stock market feels incredibly expensive right now. Look at the Schiller PE ratio of the S&P 500, 38. It's high enough to be scary. But in the hype, I found 3 companies that are incredibly cheap. No, it's not Google. Google is great. I own Google. It's still undervalued, but I'm talking about something different. It's not United Health either. These are 3 beaten down names with negative sentiments because to buy cheap, we need some problems. The story is fearful, so only very brave contrarian investors will buy them. The question is, are you one of them? I'm Adri. Every month I evaluate dozens of companies with my system, the value ratio. Think of it like the PE ratio. The lower the number, the cheaper the stock. For example, Google and Oscar are down here in the cheap zone, Apple and Disney are in the fair value area, and up here on the expensive side are the hyped companies. Hims is getting pricey, Duolingo, Robinhood, and damn, Figma. I was wrong about Figma. I didn't expect it to be so expensive right from the start. Crazy hyped. The 3 companies we talk about today are all down here, really cheap. Very unpopular right now, but potentially great long-term investment. I'm not going to reveal all 3 immediately. I'm injured, I can't do much this summer, so I am trying to get monetized. Please help me out with some watch time. Okay, I will put the timestamp below so you can skip ahead, watch the stocks, and run to the next video without leaving a like or a comment. Bye bye, adios. Arrivederci. Like always, not financial advice, just entertainment. Use your own mind for investing. Company number 1, Novo Nordisk. This pharma giant has never been so cheap in history. It's just incredible. Check out this chart. For 40 years, and I repeat, 40 years, Novo Nordisk stay above this logarithmic trend line, compounding 17.3% per year. Since 1987, they performed way better than the S&P 500. Then, last week, it finally broke down. So is the crisis really that bad for Novo? The sentiment is extremely negative. They just lowered the revenue growth guidance to 8 to 14% from 13 to 21. The old CEO is out and the new one, Mike Dusdar, is in. Is he good? I don't know. He must be capable. 33 years at Novo, from office clerk to CEO, he must be capable. But Eli Lilly doesn't care. They are gaining market shares while Novo is in denial, and they're blaming Hims for selling the compounded versions. Cherry on the cake? Trump is talking about lowering drugs cost for all US Medicaid patients. But there is a bull side for Novo. Look at their revenue, straight up to the right. The GLP-1 hype started in late 2021-2022, and the stock is now trading below the prices of back then. Under $50 is like the entire GLP-1 boom never happened, even while their revenue has doubled. For my valuation, I've been very conservative. I'm forecasting only 8% revenue growth for the next 5 years, below Novo's 11% guidance. 31 out of 100 risk score, I get a fair price of $80. The stock was trading there just a couple of months ago and might go back there sooner than what investors are thinking. Check out Novo Nordisk, it's very interesting. Company number 2. This one is even safer than Novo, in my opinion. Another great European company, ASML. Really solid. Again, the charts tell the story. Revenue is up, income is up, but the share price is down over 40% from its highs. Why? The only fear here is geopolitical, so the CEO is conservative. We continue to see increasing uncertainty driven by macroeconomic and geopolitical developments. We cannot confirm growth for 2026. A potential global trade war will be horrible for ASML because they sell their machines everywhere, especially to China, Korea, Taiwan. They're selling fewer machines right now, but their maintenance revenue is up. since more and more machines are around and they are the only one that can repair them. I really don't see the demand for their lithography machines going to zero in a world that's been revolutionized by AI. They have a monopoly, their machines are so big and complex, no one else can build them. Very strong moat is a low-risk investment. ASML has more cash than debt, share buybacks, dividends, and a good management. The current fears seems exaggerated. My assumptions are 14% growth, 32% operating margins, and 23 out of 100 risk score. I get a fair price over $1,000. I believe ASML will see new all-time high in the coming years, offering an 80 to 100% returns from the current prices. Company number 3, this one is different. It's a fashion company, so it's inherently riskier and more volatile. Lululemon. My bare voice is saying there is no strong permanent moat in fast fashions, trends come and go. Lululemon's revenue has been declining in the US, which is a very, very bad sign. The stock price has been all over the place, from the heights over $500 down to $220 6 months later, then up to $420, now down again, maybe going to $190 before bouncing back to $340. While the US is weak, they're growing rapidly in Asia. There are some improvement on the product side. Finally, they released the no-line leggings that women have wanted for years, finally fixing the big camel toe issue of the original design. Now, if we check search volume for Lululemon, it continues an healthy climb. So let's be extremely conservative. Let's assume that their growth slows from 20% of the past decade down to just 5% with 19% operating margins and a risk score of 38 out of 100, I get a fair price of $340 per share. Exactly at this trend line, that's a potential 70% return, and with this stock's volatility, it might happen sooner than we think. Those are my 3 picks for August. However, if you want to be more aggressive and you're looking for a cheap, unknown, small cap that could be a multi-bagger, I would suggest checking out a company I bought last month. I'm already down 8%, so it's even cheaper right now. I talk about it in this video right here. Thank you for watching Adri Economics. I hope you like my stock selection. Let me know in the comments if you already own any of these tickers. See you next week. Peace out.